Hello, everyone. Welcome back to our continuing series on securities-based lending platform. With us today is Mark Thompson, our Managing Director of Product and Capacity Management. Mark, if you don't mind, could you give us a little bit on your background really quick and your capacity here at TBS?
Sure. Thank you, Mike. Good to be back. So prior to joining Total Bank Solutions about 8 years ago, I was a banker for 27 years with much of my focus in treasury and balance sheet strategies. I was co-chair of the Asset Liability Committee and Commercial Loan Pricing Committee at a top 10 bank. And my last assignment was head of liquidity and balance sheet liability management at that bank. After joining TBS, I've been focusing solely on the banking side of the house in terms of product and capacity management, including pricing and ensuring that we have the depth and breadth of banks needed to take our insured deposit product.
Awesome, Mark. Thanks for that. As you know, in this videocast series, we focus on all things securities-based lending. So I was curious, how do you see using securities-based lines of credit as a part of a bank's risk mitigation strategy?
Sure. So in our last series, we talked about diversification, interest rate risk, and ALM management for a bank. In addition to that, the capital risk weighting on these on the bank eligible collateral for SBL is below 10%, largely offsetting any increase in the bank's leverage ratio should they use SBL as incremental lending and grow their balance sheet. Of course, that it could always diversify and just reduce one series or set of lending products and replace it with SBL. But if it was incremental, you could justify the increase in the bank's leverage ratio by the low risk weighting inherent in the collateral securing these loans. Further, the demand note structure of these loans further mitigates risk to the banks in terms of in the event of a downturn in collateral evaluation. So the real-time visibility inherent in this platform allows banks to issue calls as soon as a problem arises. It's an asset class that virtually never defaults. So it's the collateralization is a key component of it. And of course, quality collateral and the real-time management and monitoring of that collateral is all embedded in the platform.
That's great, Mark. So it sounds like from a risk perspective, this is a really attractive asset class. But in a low interest rate environment like this, a lot of people are going to want to know, how do securities-based loans affect net interest margin? And does risk-adjusted rate of return play into that decision?
Sure. It's a great question. It's something that's going to be looked at very closely by their ALCO and the asset liability management teams within the banks, as well as the loan pricing committees. So using a low-cost automated platform such as this allows for a near 100% pass-through of interest income to the net interest margin. Spreads reaching about 300 basis points to LIBOR currently until LIBOR sunsets later is ultimately accretive to banks' margins in this environment. To give you an example, systemically, banks' net interest margins on the U.S. banking industry today are at 2.50%. It's the lowest they've ever been. And the yield on earning assets is averaging 2.58%. So that's extraordinarily low. Right away, if you add a 300 basis point spread or even 280, 290 basis point spread to a current margin, it's to a current index, it's ultimately accretive to banks' net interest margins at this point. It couldn't be a better environment, and it'll certainly be complementary once post-pandemic lending ramps up again. Also, the ability to select a fixed versus floating and manage your duration translates well in the ALM space as bankers seek to get approval from their ALCOs. And then finally, the risk-adjusted return on capital, or RAROC, is well within normative bounds of plus or minus 5%. And this is what we'd expect, Mike, with a fully collateralized loan. You're getting a good return. The risk is greatly mitigated by, courtesy of that collateralization. So it's a terrific asset class at a time when banks' margins need it most.
Thanks, Mark. That is super helpful info. Last question, and I'll let you go. We're all hoping that we're coming to the end of this pandemic era. How do you see that environment playing out for securities-based lines of credit?
Yeah, the timing of this is perfect, Mike. I see it as a good asset class regardless of the pandemic, but right now, until commercial real estate lending and commercial and industrial lending ramp up to pre-pandemic levels, this is a terrific fill for banks. As I mentioned earlier with the last question you posed, it's ultimately accretive to margin. But now what's happening is refi activity is drying up in the resi space, residential mortgage space. And the long-term fixed rate mortgages we're seeing have high 2 and low 3 handles on them. So it's it's just a fill-in on the bank's balance sheet. It's an asset class that's ultimately dilutive to margin. So bringing in SBL at this time the timing couldn't be better. It gives you a better margin advantage, and the short duration of this allows you to fill in and then take it forward and roll forward as rates start rising next year, and you capture that rising rate environment with a floating rate asset class. So I think the timing's excellent, and I think we'll start to see post-pandemic lending levels returning late Q1 into early Q2 of next year. Obviously, we keep an eye on inflation, but that shouldn't impact the yields we see on this asset class.
Well, that is a lot of great info. Thanks, Mark. It sounds like securities-based lending at a minimum is an asset class that banks probably should be looking at right now to round out their portfolio, especially with a lot of factors going on that make it extra attractive. Thanks again for coming, Mark. Really appreciate you sharing your expertise with us.
Absolutely. Thank you for having me.
And if you're interested in learning more about securities-based lending or our automated platform, please visit us at www.totalbanksolutions.com. See you next time.